Stocks trade firm but ranged ahead of the US Federal Reserve monetary policy meet today, even as softer US inflation boosts sentiment. Realty, utilities and IT lead gains while FMCG and autos lag.
The board of 197 Communications, which owns Paytm, announces a 850 crore rupee buyback of shares via the open market route. Disappointing investors, the maximum buyback price of 810 rupees per share, a premium of 50% to the current share price, offers little solace.
The Colgate-Palmolive India stock drifts lower as analysts remain circumspect of the new CEO's growth plan, while Yes Bank's recent rally ends after it announces the final deal with Carlyle and Aventis.
Crude gains after the Canada-US Keystone pipeline leak and closure is seen disrupting supplies for weeks, even as a softer-than-expected US inflation aids sentiment.
Hello and welcome. You're watching us here on Halftime Report. I'm Manglam Malu, with me, Sonal Bhutra. We're looking at a decent screen in the markets, and I say decent because we opened well in the green, saw a bit of a dip, then there was a purchase, and now we're back at the high point of trade, closer to that 18,700 mark. What's aiding sentiment is some softening in the US inflation. That aided sentiment there as well, though things were circumspect ahead of the Fed meet. But no such problems for us. We did well, over 100 points in yesterday's trading session and doing well today as well. What's heartening, however, is the way the mid-cap index is performing today. In fact, it's outperforming, a gain of 0.5% on the mid-cap index level itself. But the broader markets, that'll tell you the story of the day. We have nearly 2,000 stocks in the green as against just about 1,000 in the red. So that is a 2:1 ratio. Fairly favorable, looking good for the markets. Hi, Sonal.
Hi, Manglam. Oh, yes, it is. And you speak about the mid-caps doing really well. Couple of these stocks, especially the financials in the broader market, look at the way they have taken off. GIC Housing, that stock is up around 10.5%. Okay, so before we talk about stock-specific news, we have the November WPI inflation figure that has come in at 5.85%, which is compared with CNBC-TV18 poll of 6.5%. So it is lower than what we were expecting. And this is the similar story to the CPI number as well. Came in below 6% this time around versus an expectation of a number higher than that. So again, it's a good news, so to say, that WPI inflation is lower than what the CNBC-TV18 poll was suggesting. Just looking at the internals as well, the WPI primary articles inflation has come in at 5.52% versus 11.04%. That is on a month-on-month basis. And fuel and power inflation has come in at 17.35% versus 23%. That is in the month of October. So WPI inflation has come in at a 21-month low at 5.85% as we speak. We also have Lata joining us in the studio. Lata, after CPI, even the WPI number lower than estimates.
Yeah, you know, the primary articles inflation has come down so sharply. It was kind of already available to us as a trailer when the CPI came. Remember, the CPI was singly brought down by vegetables. Now, vegetables would come in the primary articles category, and therefore I'm not surprised. We have to look at how manufacturing inflation has fared. If that falls, we would be better off.
It's fallen as well. Manufactured products inflation is 3.6%. This compares with 4.4% month on month. So month on month, there has been almost an 80 basis points decline in that one.
No, that would be important because all these things would go into the core inflation sooner or later. And if these fall, then you can see if wholesale prices of manufactured goods start falling, sooner or later they will start coming on into the retail inflation as well. So we have to keep a sharp eye out on that. I'm still waiting for more details on the internals. Okay, I think we now have the food index come up specifically, down 1.8% on the month. I mean, that's huge. And my sense is that it would be tomatoes and other vegetables. Tomatoes were particularly important in the CPI, and it's quite possible that that is, responsible in this case as well. There you have onion inflation minus 19.2%. So it already fell in the previous month, and it has fallen further in the month of November. So that is contributing in a big way to the primary articles inflation coming down. Food and primary articles form a smaller part of WPI. The bigger part is manufactured goods.
The entire vegetable index itself is down almost 16.8%, 17% on the month. So, of course, you spoke about tomatoes and onions, etc. Potatoes as well, down from 44% to close to around mid-teens, etc. So all of that means that things are perhaps on the mend.
No, the food is definitely on the mend. The worry always was with core inflation. the non-vegetable items in the CPI did not fall as much. Cereals and milk were actually higher month on month. So it was largely vegetable driven, and even over here, as we can see, a month on month 16.8% fall in vegetable index indicates that it is having an outsized impact on WPI as well at this point in time. It should come over to other commodities. Now you look at the all commodities index, it is down 0.3% month, whereas vegetables is down 16.8. So you can see that it has had a slightly outsized impact. But manufactured goods also see basic metals index down 1.6 on the month. The fuel and power group index is, that is the one that's up. Manufactured goods more generally is down 0.3% on the month, and therefore those would be positives. But let's leave it to the expert. Rupa Reghe-Retsuri, the chief economist at L&T Finance, joins us. Rupa, from the numbers you have heard, is this positive? Do you think that we can see WPI having a more benign impact on CPI in the coming month?
Certainly, but I don't look at it entirely from that perspective. After all, it's a producer price index, and it shows, the manufactured product price inflation also is an indicator of manufacturing companies' pricing power. And, as RBI policy statement also had said that there is a lot of pent-up, lagged price increases, etc. They are still trying to pass it on. But the fact that WPI manufactured product index is down 0.3% on month, I think that also shows growing weakness in demand.
Oh, yes.
And so despite the fact that they still have the burden of elevated costs from past months, but they are not able to increase prices because of weakness in demand. And this is consistent with all other statistics.
Yeah, the IIP number coming in as a contraction, I guess you're referring to that.
GDP, exports, then your corporate earning results, because there is a shrinkage.
So it's not all good. We are also having to worry that manufactured products or makers of manufactured products are not able to pass on their price increases. There is another number I want to comment on. It says core inflation is down at 3.5 compared to 4.5 in the previous month. Should that be read positively?
It should be read positively in the sense that clearly means that there is a loss of pricing power and cost pressures are not being passed on. There is no indication of overheating from the demand side. So I think this number carries a lot of weight from that perspective for the next policy statement.
Okay. You would expect, therefore, the governor could hold off? It could be a pause?
I will not rule out that possibility.
All right. Don't rule out the possibility.
The rate at which things are deteriorating, he will certainly observe very minutely the growth trends from other sources also. Oh
yes, growth, that's the danger mark. Thank you very much, Rupa, for giving us that spin on the WPI numbers. I think these are important observations she's making. The fact that the wholesale price guys are not able to pass on their price increases is an indication of probably weak demand. The IIP already gave us a trailer of weak demand or weak output in manufacturing, and all this will prey on the MPC's mind when they sit to make their judgment in February. If growth is a bit weak, maybe they may want to pause as early as February, though the Reserve Bank's overall language in the previous policy was a little hawkish. Overall, this is positive for bonds, so let's just bring up the bond market indexes and see whether it's had any benign impact on bond prices itself. If the yields have gone down, I think that'll come up for you in just a bit, the 10-year bond index. The 10-year bond indexes the yields did fall by about 2 or 3 basis points when the CPI numbers came in. But we will have to wait and see whether there is any impact now.
I'd love to know from Rupa. Rupa, today there is the US Fed meeting. Of course, they are expected to hike rates by about 50 basis points. How much of yesterday's inflation data will have a bearing on their commentary? What do you think that happens? And in light of what's taking place globally, how much of the current numbers, domestic numbers, matter from an RBI policy standpoint?
Yeah, that's a very good question. I think the way things are panning out, not just in India, but in other emerging markets as well as other advanced countries also, central banks now will start giving more importance to their domestic growth inflation dynamics than just taking cues from what US does. We had seen that last time also, the way Bank of Canada reacted after US Fed increased its policy rate by 75 bips. Because you see, recessionary tendencies are growing everywhere.
Yeah.
And in all these, even in India, our inflation targeting is flexible inflation targeting. It's not fixed inflation targeting. So growth considerations are not entirely ruled out.
Okay.
So, and as I told Lata, our, various multiple data sources now are pointing to weaknesses in manufacturing sector, demand, overall demand, which is a main employment generating sector.
Yeah.
So naturally, Reserve Bank of India and MPC members will take into account all these incremental data points before, going for aggressive tightening or doing overshooting of tightening.
All right. We'll leave it at that. Rupa, thank you very much indeed for joining us. So the CPI brought the Indian yields from about 7.3 to 7.27. And today they have gone down from 7.25 to 7.23, or actually 7.26 to 7.23. There's been a 3 basis point fall.
Okay.
Just as Rupa says, there is now a small corner which believes that the RBI could pause as early as February, though their December 7th statement clearly indicated they are not done with removal of accommodation. As they said, the worst of inflation is behind us, but the job is not done. That clearly was there. So it anyway becomes open, and there are so many events. You have the US Fed, and then you have one more inflation print, both in the US and then there are non-farm payroll numbers. So I guess it's still very open till the first week of February. Okay. At the moment, we can only say it's a little positive in terms of the RBI's.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. And as promised, let's talk to the management of Borosil Limited just to get a check on demand trends and the business outlook going forward as well. We are joined by Shrivar Kheruka, who's the MD and CEO at the company. Shrivar, good afternoon. Thanks a lot for joining us. I just wanted to get a check on how demand has been in Q3. We did see some margin compression in Q2, some decline in revenues as well, profitability as well. How are trends right now in Q3, and how was the festive season?
Well, first, thanks for having me. We've seen a very robust demand all through the festive season. So Q2, the demand has kind of flown over to Q3. And we see in general, India is in a bright spot for end customer demand. And this applies to both our scientific as well as our consumer divisions. We see really a very enthusiastic end offtake. As far as margins are concerned, obviously the margins in the first half were impacted by high inflation. Inflation has since cooled off. We unfortunately had a little bit of a delay in our project implementation for our new production unit, which is delayed by about 3 months. And this also has impacted our margins to some extent because we had to buy more material from outside versus producing it ourselves, which has a detrimental impact on the margin. So some of it, I would say the macro scenario has improved from an inflation point of view, but micro for us, we'll probably have one more quarter of some pain as far as margins are concerned.
Okay, so you spoke about 2 things that impacted margins. One is delay in internal production capabilities and also raw material prices as well. Now, where does it stand? Will you be able to utilize your internal produce for usage as raw materials? And how much have raw material prices fallen by?
Well, there's 2 aspects. I'll address the raw material pricing first. There's 2 aspects of pricing. One is when you import raw materials, you have the cost of the material itself and then the freight. So I won't say the cost has fallen much, but the rate of increase has stopped, meaning to say that the prices are flat. However, the freight is what has fallen. So there's been a substantial reduction in container freight rates, which has therefore impacted or improved our landed price of various raw materials. And that's really what's driving the benefit for us. As far as but on the other side, also anything imported in dollars, the rupee has depreciated, in the last few months. So it's kind of more or less at zero in terms of the reduction, but there's no increase any further, which itself is a boon.
All right, that makes sense. So, what do we expect in the second half of this year? You said that the consumer business was extremely strong for you. That's about 70% plus of your overall business. The first half of this year, you've done revenues of almost 9% in terms of growth, margins around 16%. Second half, are we expecting you to do better than the first half? And if yes, how much better?
Well, actually, I think my numbers are much higher. The consumer business grew high double digits, in fact, in the first half of the year, and I think that will continue in the second half as well. So I think we were more than 30% up in the first half, and we see substantial, let's say, traction even in the second half, and that growth momentum to continue. And like I said before, the production, our own production, will kick in now at the end of Q3, which means in Q4 that our margins ourselves should further improve again. But growth-wise, I see the trend, the momentum of the first half continuing into the second half.
Right. I meant the overall business, not just the consumer business. The overall business has grown just about 9%. And that brings me to my follow-up on the pharmaceutical business as well. Post-pandemic, what's the kind of lab demand that we're seeing? Because we did see a big dip in the pharma packaging vertical, 35% dip year on year. So what's the outlook on that one? And as a result of the overall outlook for the second half?
Yeah, so that's probably correct. We had, last year, the pharma packaging business grew by 60% the year before, and that was primarily driven by, COVID sales of various therapeutics or, injectables for COVID. That went away this first half of this year. Although now we've seen, substantial export demand on the pharmaceutical packaging side, and I do believe the second half of the year will be much better than the first half. And we will probably show growth versus the last half. So versus a minus 30% in the first half of the year, the second half of the year should have some growth over the last, year. So on the scientific side, I'm pretty certain we'll have a good growth in the second half.
Okay, so good growth on the scientific side expected in the second half. I wanted to speak to you about the demerger timeline as well. The last when we spoke was when the NCLT approval was recently approved for that. How much more time do you think this will take, and by when will the two list separately?
Yeah, so that's a great question, because that's something we discuss fairly often here. The challenge is the timelines are not really in our control. There's many regulators who are very busy with many things going on. But the latest update is NCLT has asked us to have some meetings for various stakeholders in the first week of February, which we will do. And post that meeting, I think it should take between 2 and 3 months to actually get the final approvals, and the listing takes probably a month more. So say 3 to 4 months post-February, we should be on good grounds to have then two separate listed companies. All
right, that makes sense. Let's talk about your verticals individually then. You have given us medium-term targets for both your consumer business as well as the pharmaceutical business. And for our viewers, I'll just spell them out. For consumer business, you expect a revenue compounding of more than 20% with improvement in EBITDA margins. And for your scientific products business, you expect a revenue compounding of 15%, maintaining EBITDA margins at current levels. And you are also targeting cash flow efficiency. So if you would give us some more color on this, for the consumer business at a 20% revenue compounding, what is the sustainable margin level, and what is the cash flow efficiency that you're looking at in your scientific business? I mean, what are the working capital days right now? How much are you targeting them to come down by?
Yeah, so well, I think the consumer business, we will maintain that growth, that CAGR growth of 20% plus, in the short to medium term. In terms of margin profile, you see, I think there's a big shift. We were importing a lot of products from various countries. And with this push of Make in India, we are also actively investing almost 600 crores in manufacturing in India. And that's going to help improve the margin profile. And that EBITDA over the next couple of years on the consumer side should keep rising and go north of 20%. And that's really the focus or the target for us, to maintain the growth as well as improve the EBITDA percentage on the consumer side, which I think we're well on track to achieve. On the scientific side, yes, I think 12 to 15% CAGR growth should be anticipated, and there the EBITDAs are slightly better. They're already north of 25%, and that's where we should maintain them. The cash flow efficiency, when I mentioned, it is actually for both the businesses, because we do have a challenge when we import product. That is, you need to buffer in a lot of let's say supply chain challenges and so on. So you have to have more inventory. Whereas when you produce ourselves, naturally we should see almost a 30-day reduction in your in the working capital cycle. So which the working capital cycle, if it's 120 days now, it should go down to 90 days because your inventory can go down. So
Okay.
and that would be applicable for both the businesses, both consumer and scientific.
Okay.
Stocks from the broader markets in the consumption space picking up. We have Go Fashions, which has moved to the high point of trade, and alongside that we have Westlife Food as well. Westlife Food has been one of the better performers recently after the company unveiled its 2027 plans. Go Fashion has moved higher, and as has Westlife. But let's talk about all the action that has taken place in the F&O space in the first half itself. We've seen a formidable open interest build up in both the Nifty as well as the Nifty Bank, with both these indices moving higher and the premiums on them moving higher as well. It indicates that there is some fresh long positions being added. The Nifty premium has inched higher to about 104 odd points. The Nifty Bank too has seen an open interest addition of almost 0.4 odd percent, or 1.5 lakh shares. In terms of Nifty, the active puts, as the market moves higher, the put writers are getting more and more aggressive. 18,650 and 18,700. Remember, the Nifty is below that 18,700 mark, but we are seeing some action on the 18,700 put as well. Close to around 58-60 lakh shares written on the 18,700 level, with a 59-point premium, which is telling you that 18,650 is now becoming an important base to watch out for. 18,600 put 2 continues to see a fair amount of writing. So the base has moved higher from yesterday levels of 18,350 to this morning to 18,450 to now 18,550 to 18,600. At the same time, call writers are getting jittery. We are seeing some unwinding in the 18,500 call. That was understandable given we saw some unwinding there as well. 18,600 call writers too are writing some of their positions, but important to see if the market sustains at these levels or not, because we have the Fed event ahead. And if the market does sustain, there is 1 crore shares outstanding at the 18,600 level. So if these guys start to cover, the markets will only move higher. How much higher can they move? 18,700 call writers. They are still active, and they are active for a premium of 50 odd rupees. So maybe 18,750 could be where the congestion may come by. So that's the range that we're looking at right now. 18,600 to 18,650 would be an important support. 18,700 to 750 may face some bit of congestion.
Okay, so let's take this conversation about the F&O setup and the technicals as well forward. Sudeep Shah, Head Technicals and Derivatives Research at SBI Securities, is joining us now. Sudeep, good afternoon. Thanks a lot for joining us. Well, another good day. What are the charts suggesting? Will this continue? Will the Nifty see some consolidation at these levels?
Good afternoon, Sonal. Absolutely. What we are seeing the markets right now, the way we are seeing it is that we are seeing an improvement of market texture now with US inflation coming off, and we are expecting the Fed to have more of a dovish tone, and hence the global markets could be relatively more stable in the next few sessions. Crude, dollar index slipping, US bond yields falling below 3.5, it's all hinting at a kind of a positive scenario going ahead. And with India VIX also now cooling off to 13, below 13 levels, we feel that markets are slated to move higher, and the current positive setup will continue until the time index holds its 20 dem of 500, 550 overall. We feel that the index could witness a new all-time high around 18,900 in the forthcoming few sessions. So from an index standpoint, the most crucial number for the next couple of days would be 18,500, and only a breach below this level, you would start turning cautious.
All right, and individual stocks, what do you have on your list today, Sandeep?
Individual stocks, see, what we are seeing is with the bank Nifty outperforming, our first pick would be IndusInd Bank. Now, what we are seeing is that the stock has witnessed a symmetrical triangle breakout out of its 17-day consolidation range of 1160 to 1210 with a rise of volumes and open interest, and has been the most performing stock in the last couple of days. So it's also sustaining above its 2021 highs and sustaining above its major moving averages. So what we feel is this stock can be bought at current levels with 1220 stop loss and 1290 target. Our second pick would be JSW Steel. Now, with the dollar index slipping below 104 and Chinese demand now we are seeing expected to improve with the reopening of Chinese economy, we feel that the metal stocks are expected to do well. And current chart setup of JSW Steel looks the best out of all the metal stocks. This stock has been consolidating between 730 and 750 levels since past 5 days and has shown signs of a breakout with volumes today above 750. So, and if we also see the moving averages, it's also sustaining above its 20-day EMA. And every time the prices are retesting this 20-day EMA, we are seeing there is a considerable bounce back of 10 to 15% from those levels. So currently, a few back, it had tested 730 and we are expecting the stock to rally up to 790, 800 levels in the next few sessions. And this can be bought with 730 stop loss.
Okay, all right. Thank you so much for joining us, taking us through your technical picks. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, Apollo Hospital Sunita Reddy spoke to my colleague Ekta Batra at their flagship Indraprastha Hospital in Delhi NCR. Talking on the core hospital business, the company expects occupancies to move up to 70% with revenues generated from the oncology space to close at around 1,700 crore rupees this year itself. Listen into excerpts from that exclusive conversation.
Last quarter it was at 68% and we did have a lot of fevers also. But the important thing about Apollo is really one, a denominator has changed. So we have a 9% increase in operational beds. So therefore, you know, you have to keep that in mind when you look at occupancy. I think the second most important thing is that our ALOS has moved from 3.78 to 3.4. And therefore our asset utilization and absolute number of patients have grown by 19%. So that, you know, these figures on occupancy will keep changing. But these are the triggers, levers that we use.
But any kind of guidance that you have in terms of what your target occupancy would be, where do you want it to sustain? I think it's around 70%.
Yes, you're right. It's around 70%. And I think with this level of ALOS and the current case mix we have, this is, you know, it will generate a lot of free cash flow.
But this case mix, you know, one of the views is that complex surgeries have increased quite significantly because the awareness is greater. So in terms of your case mix, is it much more complex as compared to pre-COVID?
So at Apollo, we've always focused on our COEs, Centers of Excellence, which are cardiac, orthopedic, neurology, transplants, robotic surgery, and a lot of general surgical work and mother and child. So as we look at these specialities, there has been a tremendous increase. So if you take oncology, for example, when we started our investment cycle, we were at 800 crores of revenue. Then we invested in the proton, which really no one in Southeast Asia had done. And hopefully we should close the year with 1,700 crores of revenue coming from oncology. But the premise of all this, the base of all this is that our clinical outcomes should be the best in the world. And therefore we attract the talent. And therefore we can invest in the technology.
The Proton Therapy Center, how much is it generating in terms of revenue? What is the occupancy like? Do you need to set up another center? Can we expect that?
So in terms of revenue right now, it's about 260 crores of revenue. But we're only at 50% capacity utilization. And I think, you know, during COVID, we didn't get that many patients, but it has picked up tremendously. And I think, you know, we can, like I said, 50% capacity utilization, which will increase because we're opening the third gantry next month.
You know, the other big talking point post-COVID is definitely medical tourism, medical value tourism. There's so much of an impetus from the government as well on it. And companies or hospitals are looking at capex, which is catered to inflow of patients from abroad. Where does it stand as a percentage of sales? How bullish are you on it as a prospect?
You know, people have always measured it as a percentage of sales. So we should close the year with 7%. But having said that, the absolute revenue coming from international patients has actually grown over 19% over 2020 when it was peaked. So in absolute terms, there has been an increase, and I think the potential is to go to 20% of revenue, and we believe that that Apollo will be the biggest player in international patient traffic. And I say this because of our locations. In 2 years, we'll open our Gurgaon facility. We have Delhi, Gurgaon, Bangalore, Hyderabad, Chennai, and Ahmedabad. Being located in all of these centers is bringing us patients from across the world.
Acquisitions, would you look at acquisitions just to fuel that aspect of growth? You have made smaller acquisitions, but something larger, any kind of pipeline you can share with us?
You know, I think any acquisition that is value accretive makes sense to us. So we did Gurgaon, which is brownfield. We're setting up a hospital of the future in OMR in Chennai. So clearly we are expanding our footprint. We're adding 2,000 beds in the next 4 years. So it is a huge expansion. And acquisitions, if something comes across, something comes our way, of course we'll look at it.
All right, we take that point. That was a piece from a very special series we've planned for you, Medicine Box, a deep dive into the world of pharma and healthcare. Catch the full conversation this evening at 5:30 p.m. only on CNBC-TV18. Welcome back. The mid-cap index gaining from strength to strength, and it is the financials. We've been speaking about a lot of the non-banking stocks, but now just take a look at some of these banking stocks. We have IDFC First Bank, which is doing well, currently moved to the high point of trade, a gain of almost 4% from the lows. Apart from that, the PSU rally continues. The next one is PNB on the list, which too was flat for most part of the day and now has picked up some steam, so currently doing well. Union Bank too follows suit with a gain of almost 2%. In fact, this year, Union Bank is up 120 odd percent. So that's the kind of rally that we've seen in a couple of these PSUs. Moving away from banks, we have IRB Infra, which has spiked quite a bit. In fact, this week, the stock is up 13%, done well this year as well. And this month, it's up almost 15 odd percent. GAIL continues to do well. GAIL has moved to the high point of trade as well. On the flip side, stocks which are not doing well, Gujarat Gas is at the low point of trade. Page Industries, the management did cite some sort of demand problems going forward. So that is the other stock which is currently at the low point of trade. And Hindustan Aeronautics, some bit of profit taking after a stellar rally that we've seen on that counter as well. But the advances far outnumber the declines, and we have the markets doing extremely well, 200 points on the Sensex. Take a short break, come back, get you more on the markets, stock-specific action, perhaps some commodities as well.
Welcome back, and joining us on the show now is Peter McQuire. He's CEO Exim Australia. And Peter, welcome. So much happening in crude oil. We saw 4% gains yesterday after 3% of a jump up on Monday. So after that 10% decline in the previous week, this week seems to be really gaining back all those losses, and $80 is back. How do you look at these current prices, and where do you see the support coming from?
I think there's just so much data to drop over the next matter of, hours and if not a couple of days for crude to take a real steady look at where things are. Yes, I agree with what your synopsis is. What you have seen in the last couple of days has been very bullish. And I just saw that UK's just announced its inflation and it's a pullback. So that's a good sign. And the other side of it is we might be in a little bit more upward momentum. So we did say it's going to be choppy, and choppy it is. So maybe it's a few dollars higher next week from where we are today.
Peter, most of the banks and brokerages seem to be talking about $100 per barrel as an average coming back in 2023 and perhaps 24 as well, because the investments may have peaked out, demand not so much.
Well, yes, exactly. I mean, look, as far as demand's going, Manisha, we're going to be close on that 100 million barrels a day. That's the storyline as far as the headline number. And you've got China opening up now. You've got, let's say, a different philosophy in Hong Kong and across Asia with the COVID lockdown. So I would say that should give us more consumption. And the next part of it, of course, is with that US dollars coming back, it's at 104 now, and I think there's even more pain ahead for US dollar to the downside. So I wouldn't be surprised that'll lift up crude as well.
Okay. Peter, when you look at this year, the range has been, almost 70 on the lower side to 139 on the higher side, and that is clearly a $80 of a range that we've seen. Yeah. What kind of a range are you anticipating for the next year now?
Oh, Manisha, if I'll put on two hats, the first hat is a trader. I hope it's as volatile next year as it is this year because it's just been outstanding trade, crude and oil energy. But I'll take that hat off now. I think it's going to be a tighter bandwidth, and I think you're going to be looking around that, where it is at the moment could be the low side up to that 100 to 105, sort of 110. If we don't see any dramatic impacts as far as geopolitical, supply concerns, and what happens, I want to keep an eye on dollar, Nisha, because I think that's going to be a really wild trade next year, US dollar.
And what range are you looking at for the dollar index then?
Or it's been only a couple of weeks ago we were talking, well, maybe more than that, 8 weeks ago it was 114. So I think I won't be surprised to take a 102 handle out. I'm interested to see what Fed Chair Powell has to say. There's no doubt. I mean, it's got to be 50 basis points. And I think that's going to be a softness that for the dollar. Lagarde will come out as far as Eurozone and they'll punch that one higher. So, yeah, I won't be surprised to see the dollar index take more pressure to the downside.
So even as you said, 102 is a possibility there. What's the highest side that you see here?
Well, if you're over next year, I mean, you've been talking for the whole of the year, I won't be surprised to take back out to 110 because I think there's going to be a lot of currency wars at play. I'm not sure what's happening as far as Japan. The pound seems to be very strong now compared to what it was 2 months ago or 3 months ago. And the euro seems to be choppy. So I've got to see how aggressive Lagarde's going to be with the ECB. You've got some inflation stories on three of those members of the European Union are above 20% inflation. So I think they've got a harder job ahead of themselves, Eurozone, than what the US does.
Peter, well, as you rightly put, much of the price moves that we've seen happen in last 3 or 4 months clearly have been macro. Maybe the 60-65% of a move in a commodity was macro. But when you look at the fundamentals as well, whether it's about Russia, Ukraine, the Keystone Pipeline, that seems to be adding a lot of support right now, or the Chinese demand. What is it that you will watch out for going forward, apart from macros, when it comes to fundamentals on ground?
Well, I can't get away from Professor Larry Summers, emeritus professor at Harvard, and when he said that, he made a mistake. They made a mistake when they cancelled the Keystone, made a mistake slowing down, was just all of those key points and all kinds of permitting activity. They've really handbraked the crude industry in the US, so I've got to keep an eye on that. I've got to see whether Biden wants to turn around any of those those policies. And I'm curious to see what consumption is going to be out of China, Manisha, because this is a game changer. If this is open, then I think it's all game on as far as consumption for Chinese crude.
All right. So a big range of volatility may continue for the crude oil prices, and 102 to 110 for the dollar index is what we are working with for the next year. Of course, these are forecasts, and there are so many ifs and buts that we will watch out for as we go across that road. Peter McGuire, thank you as always for joining us with your sense on energy. With that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.